Welcome to episode 56 of the Cashflow Connections podcast. Our topic for today is two major announcements, FreedomFest, and discussing the housing bubble. As you probably assume, we're going to talk about all those topics today, but something kind of unique about this episode is that there isn't a guest. So this is Hunter Thompson here acting as both host and guest today. So we're going to get into this unique episode for a variety of reasons, which I'm sure you'll understand shortly. So the first and most important of the two major announcements is that I got engaged last week, which is one of the reasons there wasn't a episode over the week. I was in Paris, France, and then also in the south of France, in Marseille, and then also in the south of Portugal, and then Lisbon. And I actually proposed to my girlfriend and now fiance at the bottom of the Eiffel Tower, where we actually had a horse-drawn carriage pick us up. This is something I arranged beforehand. I've obviously been thinking about this for quite some time. Either way, I'm extremely excited. She's the love of my life, obviously. And, we're a great team. In fact, that's kind of an interesting segue into the next announcement. What she does professionally is she does corporate events for technology companies, usually, Series B, Series C, Series D technology companies that has a significant amount of funding. She's put on some incredible events. Her portfolio is insane. Name of her company is Dynamo Events. Website is dynamo-events.com. Long story short, because of the fact that we are quite close and she's been a little flexible with her rates, which can be quite considerable, we are actually going to be working on a 2-day conference together in which Cashflow Connections is partnering with our good friends and partners over at FIBI, which is short for Investors by Investors. The 2-day conference is going to take place at the Marriott Hotel in Los Angeles, California. It's actually in Marina del Rey. The point there being, it's not in Las Vegas like every conference is. And by the way, I love conferences in Las Vegas. We're going to talk about one in a second, but I know it's a little bit of a breath of fresh air to actually go to a city like Marina del Rey where there's tons of restaurants, there's tons of other things around the city. So long story short, we're going to creating a completely awesome, unique, educational, jam-packed 2-day conference with For Investors by Investors taking place November 10th through the 11th, again at the Marriott Hotel in Marina del Rey. The name of the conference is the Intelligent Investors Real Estate Conference, which I think is appropriate for a variety of reasons I'm sure you can figure out. There is going to be some incredible guests. We are just early on right now getting everyone locked in. We should have everyone locked in the next week and a half. Right now, we already have Ryan Smith from Elevation Capital Group. He's going to be there. He's on episode 53 as well as episode 16. Gelt is going to be there. You may remember them from episode 21. They went from having $0 under management in 2008 to $1 billion under management in 2018. Remarkable. If you listen to episode 21, you can see why. They really know what they're doing. They've been focusing on multifamily for quite some time, really accurately predicted the timing of the market, particularly in markets like Phoenix, and they're also heavily involved in Texas, I believe. We also have Bruce Norris in the Norris Group, and then all these other guests that have already been guests on the show, David Coe, Matthew Owens, Christina Sutter, Jeremy Roll, all of those that I just mentioned, those are actually all For Investors by Investors chapter leaders. So now you can see why I'm so excited about partnering with these guys. These are some of my best friends, some of my closest partners in the industry, and they are very cautious about their brand. For Investors by Investors is a networking company that has, I believe, 19 chapters all over 3 different states. They have about 25,000 investors in their networking group. They basically have networking events which are really focused on education rather than sales and sales pitches. So Jeremy Roll is one of the co-founders. Him and his partner, Ella San Jose, they just got sick of going to all these networking events where it's really just an upsell for a cruise or some kind of trip or something like that. And they really just wanted the content because it's very challenging, especially back then. It was very challenging to get good information, especially about things like syndications. I mean, the podcast industry has really changed that. I'd like to say that we're playing a significant role in providing some really high-level, sophisticated content for free. But back in 2007, back in 2010, that just wasn't the case. And if it was the case, it would be very challenging to find. You wouldn't know who to trust. So long story short, it's a really good match for FIBI, who is focused on the in-person networking events, and Cashflow Connections, where we focus on the podcast. It's really interesting. I mean, just to say a quick note about that, I am really happy with the amount of content that we've put out and the quality of content that we've put out, and the fact that I frequently receive emails from investors thanking me. I know that I may have mentioned this on the program before. I recently received an email from someone saying that they completely passed on a deal entirely because of some of the things that we have said on this program, which is probably the most powerful compliment I've gotten. I mean, I do like helping people be educated, feel confident to make choices, etc. But to avoid, and by the way, I know the deal they're talking about. It's a very good thing that they passed on it. That is, to avoid loss of principal is extremely powerful. So long story short, I'm happy with the amount of content that we've been putting out. The challenge, though, is that most of the real moves that I have made professionally, most of the things that have actually helped me scale and grow my business significantly, have been because of really strong founded in-person relationships. And so if you have a lot of knowledge, the challenge is if you don't have a team, it's really hard to put that knowledge into practice. Of course, you can build relationships over the internet. We've all done it, etc. But I really wanted to create an environment where you can create memories. You can create really long-lasting, lifelong relationships, because that's what real estate is really all about, in my opinion. I mean, people talk about the financial freedom component. That's a huge part of it. But the memories, the friendships, those are the things, the relationships. To be able to have meaningful, important relationships with successful entrepreneurs is extremely important to me. And so we wanted to create an event which would facilitate both the educational component as well as that in-person networking component. And I think that we've going to do a phenomenal job on this. Like I said, Chrissy, who's the name of my girlfriend and my now fiance, incredibly detail-oriented. The amount of things that she's brought to us to prepare for this event, the attention to detail, I am just going to be extremely excited about it. So if you're interested in buying tickets, they're going to go on sale next Monday. That's going to be August 27th, and you'll have access to the link. I will send an email out to everyone that's on the email list. I'll also make another announcement on next week's episode. But if you're not on the email list already, go to cashflowconnections.com, create an account. You'll get all the emails about this, including the discount code for an extra $80 off. You're going to get a really, really good deal. All the details will be announced next Monday via email. But for right now, mark your calendars, November 10th through the 11th in Los Angeles. By the way, I'm clearly putting my name on this. FIB is putting their name on this. They're very protective of their brand. And we have some major players that are going to be speaking at this event. It's going to be an absolute all-star event. And I am really looking forward to meeting a lot of you in person. So hopefully you'll join us there. So on the next topic, which is FreedomFest. So as you guys know, I have been talking a lot about FreedomFest. It was my first year, and I wanted to provide you some of my thoughts because it's really fascinating. I know a lot of you would be interested in attending in future years. I think from an attendance perspective, pretty remarkable, pretty awesome. If you have a moment to go to the FreedomFest website and look at the agenda of what was available to the attendees, if you're interested in that sector of the economy, that sector of education, there's a lot of really great speakers, a lot of really great content, so many interesting topics. Peter Schiff, Doug Casey, Jim Rogers, etc. All these people are all-stars. I also was able to really continue to build relationships with a lot of the sponsors there because I know a lot of them personally. We met through networking, but also through things like this podcast, etc. It's good to meet people like that. Michael Flight is someone who I was able to meet in person for the first time. He's been on a guest on the program. It's always great to shake someone like Doug Casey's hand and show some FaceTime. As far as doing it next year, it's very likely that I will. I really did like being able to speak on those panels and get my perspective known because it's interesting, right? There's a lot of people out there that are really concerned about recessions, and their view on recessions makes them invest in things that I think are extremely conservative, and so much so that it may not even be considered conservative. I mean, when you talk about investing 20% of your net worth in cash and 20% of your net worth in gold, which is a common thing in that circle, I just don't know that that is on a risk-adjusted basis the best way to handle that. And of course, this is not investment advice. That's just my thoughts. But I think you can take the same data that they're looking at, the lack of income growth, the baby boomers, the fact that we're in the really late stages of the cycle. It's undeniable. All those things are mathematically the fact. It's just data. You can look it up and verify it all of yourself. The fact that Social Security is unsustainable. And even if you go to the government's Social Security website, you're going to see the first thing they're going to see is addressing this concerns of insolvency. And by the way, when I say that they're addressing the concerns, they basically say, yes, this is going to be insolvent. There's going to have to be a significant reduction in the benefits which are paid out. I mean, it is a fact. Now, you can take all that data and you can say, yeah, let's invest in gold and silver and cash. But you can also say, let's invest in mobile home parks. Let's invest in self-storage facilities, which historically have performed very well during recessions. That way you can get the benefits of owning real estate, cash flow, appreciation, tax benefits, etc. But you're making a legitimate return on your investment and you're getting reliable cash flow to pay off your expenses, but you're still using that same data. You're basically shorting the economy, but getting the benefits of investing in real estate. I just don't know how you can argue with that. It's going to take some convincing for some of the people that are attending those events, but from a mathematical perspective, from a data-driven perspective, taking the emotionality out of it, if you're using appropriate leverage, I think it's very challenging to debunk the mobile home park or self-storage thesis. So, next up, I wanted to talk to you guys about one of the movies that was played at FreedomFest, which I was asked to be on a panel at. This was called The Housing Bubble. It's actually available now on Amazon. It was also the world premiere at FreedomFest, so it's now available. It is basically taking the Austrian economics view, and looking at the housing bubble and basically explaining it from that perspective rather than the perspective that we've all heard a million times from things like The Big Short, etc. Basically, free market capitalism got out of hand, and now we have this massive bubble. So I wanted to share with you some of the thoughts I had about this topic just because I prepared for this panel and I thought that a lot of you would be interested. So one thing that the movie did a really great job is that in 2001, 2002, there were so many politicians explicitly calling for not only expansionary monetary policies, but literally saying, it's our duty to allow people to get mortgages who would not be able to get them in a free market. Right there, red lights, red sirens, warnings should be going off. Whenever politicians start being extremely generous, then you know something's wrong, right? Because it's sounding as if they're the ones being super generous. It's sounding the ones that, they have the duty, but really they just feel like it's appropriate to use other people's money to facilitate certain things. But my point is, they're literally saying they would never be able to get a mortgage in the free market other than for government action and central planning. So we have to go through and do it. When I first started understanding the implications of this, and then when I start understanding that Fannie Mae and Freddie Mac were under explicit instruction from the federal government to purchase more than $1 trillion of subprime or other risky mortgage debt, I felt like I was the only one that really got this. Like, do you mean to tell me that the majority of all the mortgage debt in the United States and the vast majority of all, especially the riskiest loans, were specifically under directive from the federal government? I remember back then continuing to think that I must be misunderstanding something, or that either that or I must be the only one that completely grasped this or the implications of this. $1 trillion directive to basically buy something that the free market was not providing, or create something that the free market was not providing, depending on how you look at it. I think it really highlights people's inability to think clearly if you use the term government, because people believe that has a veil of authority, a guise of legitimacy, because they're using that word. If you just replace the word government with any other industry or any other company and apply the same logic, you get something radically different. Like, say, for example, that you're a dairy farmer and there's a milk production company that approaches you and says, look, we got a new directive from the higher ups, and now we're explicitly going to purchase lower quality milk. The type of quality milk that no one else would buy, the type that isn't inspected, and if it was, it wouldn't even pass inspection. And we're not just going to purchase a little bit of it. We're going to talk about $1 trillion of extremely low quality milk, and we're not going to inspect the quality of the milk at all. Now, if you're a dairy farmer, you're going to look at this and say, what do you think is going to happen in the dairy industry? You're going to see a massive boom in the business. You're going to see dairy farm prices skyrocket. Your neighbors are going to start investing in dairy farms. Everybody's going to be making a ton of money until a couple people start dying because of the quality of milk that they're eating is not healthy. And then all of a sudden, what's going to happen? We're going to hear dairy farm business, completely unregulated, goes crazy again. Free market capitalism is to blame. Now Paul Krugman has unveiled his proposal for the creation of the Federal Bureau of Dairy Product Regulation Agency with 5,700 employees and a $500 billion annual budget. That's exactly what you would expect. But if you say, oh, it's a government directive, they're doing it for the right reasons, then everyone's ability to logically reason just goes completely out the window. It reminds me back to when this was all taking place, and I started hearing all this chatter about the fact that this financial crisis, this massive multi-trillion-dollar implosion, which was all over the world, but particularly in the United States with housing, it was because of the repealing of Glass-Steagall. And this is just a proof of the fact that ideological narratives, they do not care what the facts are. I mean, this myth continues to be perpetuated to this day, unfortunately. This is something that to this day is mentioned. I mean, Obama himself said that this doesn't have anything to do with it, that he could see no proof that that was the case, that the repealing of Glass-Steagall caused this problem. Not to say that Obama is everyone's overlord when it comes to economic theory, but the point is there isn't a lot of data that would make this make sense. And there are still people, including economists, that hold this belief. And the reason for this is it's basically the one piece of legislation that people could turn to be construed as deregulation. So they just look at it and they say, don't look into the implications. They just say, that's your problem right there. That's your problem right there, because it's the only possible form of deregulation that they could possibly blame the financial crisis on. So let's grant them that. Let's say it could be the case. It could be, right? Maybe it didn't help. So on one side of the argument, you have the repealing of Glass-Steagall. We're going to grant them that it's possible. Let's try to weigh the scales, okay? On the other side of the argument, you've got 115 regulatory agencies specifically designed to give a very few amount of companies an oligarchy of the entire financial sector. You've got tens of thousands of employees whose job it is specifically to regulate the financial sector. You have more financial rules, regulations, laws than any person or even a group of people could possibly understand, not to mention even agree upon the implications of. You have a monopolistic currency system, which you literally go to jail if you try to compete with in some kind of meaningful way, which is literally backed by the police and military, which is unlike any power the world has ever seen. And you have the single greatest conspiracy fraud to ever take place, which is the Federal Reserve, which not only has the capacity to expand and contract the money supply at their will to the tune of trillions of dollars, but also controls interest rates. If you may remember, I don't remember what episode it was, but Ethan Pinner, who probably knows more about this topic than anyone, said that interest rates are the single most important determiner of all financial assets. I'm going to repeat that. Interest rates are the single most important determiner of all financial assets, especially over the aggregate. They are controlled by 12 people. The currency of 350 million people in the United States and arguably 7 billion people worldwide, the global currency is controlled by 12 people. And you know what they call their group? It's the Federal Open Market Committee. That's right. So when I look at that and I say, okay, you've got this one piece of what you may be construed as deregulation. On the other side, you have all this mountain of regulatory burden and hurdles and conspiracy, corporatocracy, a government-created oligarchy. It's just very hard to make the argument that Glass-Steagall, or the repealing of Glass-Steagall, created the financial crisis. But again, people still are going to make that case. So going back to the Fed real quickly, it's actually pretty fascinating that the people who complain the loudest about evil corporations, they have a complete blind eye and completely ignore the same argument when it comes to the Federal Reserve, which is unquestionably the most rampant example of corporatocracy, corruption in the United States. This is especially troubling when you consider the fact that inflationary monetary policies of the Fed, they most directly negatively impact the middle and lower classes. And these are the same people that this same group is supposed to be there to defend. Now, a lot of it has to do with the fact that they're not knowledgeable about this topic, but nonetheless, it's very troubling. And obviously, the reason that this is the case is that the middle class, the lower class, they're less likely to have assets that increase with inflation, like stocks and real estate. And they're much more likely to have a significant portion of their income on fixed income, things like Social Security or pensions or housing subsidies. So when you have inflationary monetary policies, you have increased amount of the values of stocks, increase in the values of real estate. And so upper classes who have a significant portion of their net worth tied up in those assets, they're basically net even. But when you don't have that and you're relying on Social Security, you're getting completely squeezed. Not to mention that one of the ways to move up out of the lower class is through investments. Now, this requires savings, but this entire system, especially inflationary monetary policy and the suppression of interest rates, this is set up to completely eliminate this because of the deteriorating effect inflation has on savings. Basically, people know if they spend their money now, they're going to get more for it than if they spent their money later. So there's no real incentive to save, especially when you can't get any meaningful return in your bank account. And of course, none of this was addressed in the movie The Big Short. It was a great film. I loved it. I've watched it probably 10 times. I mean, I really, really like the film. I'm a huge fan of Scorsese. I'm a huge fan of DiCaprio. I mean, they kill it, right? What are you going to say? But when you're watching that documentary and you have the same perspective on the economy that I do or the other Austrians do, you know, it's like watching a documentary about someone who's sick. And the whole movie is about trying to figure out why he's sick. And so you have these videographers following him around at work, and all day he's drinking soda all day. And so they're interviewing these doctors and they're talking about how bad soda is. And they're looking at studies about the connection between sugar and diabetes and other negative health effects. And everyone starts talking about why we need a soda tax and a sugar tax. And we need bigger labels on the soda that say, hey, drinking 12 of these is kind of bad for you. But you're sitting there watching this and you happen to know the guy personally. And you happen to know that when he leaves work, when the cameras aren't rolling, he goes home and shoots a cocktail of steroids and heroin in his eyeballs. And maybe that's the reason that he's suffering from some negative side effects. And you're just like, are they never going to talk about these steroids and heroin that he's doing? So, I mean, from my perspective, that's not even an exaggeration. You know, going from a federal balance sheet of 900 billion to 2.2 trillion and then up to 4.5 trillion in short order, there is just no way around that being comparable to doing incredibly inflammatory, addictive, and problematic drugs. Now, since we've gotten through all of that, I did want to make a note though. I think a lot of people that have this perspective on the economy that I do, they look at some of this data and they look at seeing all the moves the Federal Reserve is making. They see the negative situation that's going on with Social Security and all the other negative data that's out there in the world. I mean, all you have to do is open your eyes and you can see negative data, of course. It can make you feel a little bit like a curmudgeon. And if you let it get to you, it can be a really challenging lifestyle. Because I am not a negative person, right? I am not a doom and gloomer. Every day, I see a tremendous amount of opportunity. As an entrepreneur, as a real estate investor, I just mentioned that I got engaged. I have a great relationship with my girlfriend. I'm very excited about the future, obviously. So I see an opportunity to take advantage of the situations that the Fed is creating or the fact that Social Security is creating this situation. I see advantage. I see opportunity everywhere. So when I look at real estate investments, I love jumping out of bed, looking at new deals. And I don't want people to get the impression that just because you have this perspective of the economy means that you have to be a negative naysayer and a doom and gloomer. There is a tremendous opportunity happening right now in the real estate market. It's been happening for 10 years and it's going to continue to happen. There's always an opportunity out there. As long as you continue your education, as long as you're continuing to network and build meaningful relationships, have an infrastructure in place, you can really take advantage of things, especially when the market corrects. But I will say that I have recently talked to about 4 of the operators I most respect in the space. All of them are currently active right now to some capacity. 3 of them had to reschedule our call because they're in the middle of some close. And that's a really important data point. I mean, these are people with somewhere between $500 million to $1 billion under management, and all of them are active right now. So if you're scared about prices, if you increase the amount of education you have, or you increase the amount of networking you have, you're going to have access to deals in all stages of the cycle. So I just wanted to end on that because don't want to get too negative when there's obviously so much to be excited about. So before we close up, I do want to just re-mention 2-day conference, Intelligent Investors Real Estate Conference 2018. It's going to be November 10th through the 11th at the Marriott Hotel in Marina del Rey. I've already mentioned some of the people that are going to be there. I don't need to convince you. If you listen to this podcast, you know the content is going to be off the chain. The details are going to be available next Monday, August 27th. You will get the details all sent to your email. Trust me, you are not going to want to miss this one. I wouldn't be as excited about it. I wouldn't be doing it if I wasn't super excited about it. It's going to be a really special time, and I look forward to seeing you there. All right, have a good one. All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.